the show. I've seen a lot of activity coming from your end. I believe you did a TED Talk recently, so I'm just really excited to dig into your background, learn more about what you're doing in the family office space. So Ron, really appreciate you coming on today.
It's a pleasure to be here.
So I would love to just kick off by understanding more about your background and who you are as a person, and then we can kind of go into a little bit more about your knowledge and what you're doing exactly from an impact perspective within the family office space. So start off, Ron, just giving us background about yourself and how did you get to where you are today?
From a business standpoint, I graduated from Northwestern with a degree in economics. My first job was at Drexel Burnham, and Drexel was interesting because, at the time, Drexel was the most profitable firm on Wall Street. And this was when Michael Milken was creating junk bonds, and it was very forward-thinking firm. But I was in the room when Fred Joseph, the CEO, announced that we're going bankrupt. And I was 24 years old. So I didn't really have any stock options, or I didn't lose anything other than a good job. But I'm watching people in their 60s and 70s and 80s, and many of these people lost most and some all of their money because they had all the money in the Drexel stock. And it was a very surreal scene. I could still remember people, I could remember scents, I could remember what people were wearing, who was next to me. But my takeaway from that was that if this could happen to Drexel, which was like Goldman Sachs on steroids, this could happen to any firm. So my takeaway was that I would always be loyal to people, always, but never to a company. And because of that, I went and started my own firm. So initially, my goal was to work at Drexel, and they took 10 kids from different schools, and they put us through different programs. And if we did well, hopefully we'd run one of the divisions. That was my plan. And then the plan changed when Drexel went bankrupt. So I came back to Chicago, and I started a hedge fund. And I had no intention on doing that. But because of my experience with Drexel, I really wanted to start my own company, which I didn't prior to that. So I launched a hedge fund in 1990, which was relatively early. I just launched with a couple $1 million, grew it to about 250 million, held it for 10 years, and sold it in 2000. And then I started investing. And what we do now is we invest alongside about 100 family offices. These are families anywhere between 250 million to 30 billion. I kind of act as a funnel. I'll put money in every deal, and then I'll aggregate with other families. We don't charge anything, but I do it so I get better deal flow, because I can then, rather than putting $2-3 million into a deal, I could put in 50 or $100 million into a deal. So that's basically what we do. And then I'm in the process. I helped to create I chair the Disruptive Technology Center, the advisory board at Stanford University for the Disruptive Technology Center, and created a family office initiative. And we're in the process of doing that at another major university, which will be announced shortly. And then I sit on a few different advisory boards. So that's basically what I do.
Awesome. No, that's great. Really appreciate the background. So I guess to take it a step back here, that's interesting, going from working for a firm and deciding to go start your own hedge fund. So I want to understand a little bit more about how did your time working in the hedge fund space and running your own hedge fund, help you then transition into the family office space, and what were some of those skills that you were able to easily transfer?
Well, it's interesting because, I thought I was, you're starting a company, a business, and I was way underqualified to start the hedge fund at the time. I mean, in retrospect, but I had a lot of confidence, so maybe that certainly helps. But you figure out stuff out as you go along, and I learned a lot. I made a lot of mistakes, but you learn as you go along. And one of the things I think, and how it applies to my work now with family offices, is it's a relationship business, and people aren't working with somebody in the family office world because they're necessarily the smartest person or the best person in this area. They're working with a person because they have inherent trust for the person. Obviously, they need to be good at what they do, but it's a relationship business. And I think I guess the takeaway from my days running a hedge fund to now is the first, second, third thing most people are looking for is the relationship. They want to make sure they could trust you. And the fourth thing they want to know is what's your background, what's your track record, etc. But it's a complete relationship business, and it's the family office market is just growing exponentially right now.
No, that's great. And so you mentioned relationship a couple times there. How has building these relationships, or how have you found an effective way of building these relationships with the family offices?
I wish I had a silver bullet to answer, and I don't. But I think it's really just being authentic. I mean, I speak at a lot of conferences throughout the world, specifically on family offices, and the best compliment I was ever paid was after I spoke one time, and two people came up to me and they just said that was really authentic, and I didn't even take it as a compliment. But then afterwards, I reflected on it. I'm like, actually, that is a compliment. And when I was talking, I wasn't talking about everything I did worked, and I talked a lot about the mistakes that I made along the way, and I talked about the what I did wrong and what I would have done over. And I think that, to me, authenticity, um, it, it comes through. And I think that people want, and I'm the same way. I want to work with people who I know have my back. My attorney is a guy named Saul. If I'm close to the deadline for my taxes, he gets more stressed out than I do.
Hmm.
I've got to calm him down. I want to work with people like that.
No, that's a great story to kind of just, bring that to color. Um, and so you said that, you talked about some of the mistakes. I'm actually curious to understand, what are some of the mistakes that you've learned from that has, made you who you are today?
Probably don't have a long enough time on the podcast to do this. It's just that I think you go in, you just figure it out when you're going along. It's not hard to set up a company. I mean, you go to an attorney, you set up, your legal documents, and you're up and running. Um, but you don't realize all the different nuances and, investor relations and communication and all that thing. So it was a whole bunch of mistakes that I had made. Nothing major, but just a whole bunch of minor mistakes. But I think that helps you, and it only helps you if you learn from it. And I learned. I think I was pretty good about every mistake I made, and I made a lot. I learned something from, and I tried not to make. Sometimes I'd make the same mistake again, but very rarely. So that was really my takeaway.
No, that's good. And what you said before stood out to me. You said that the family office space is exponentially growing. So can you talk a little bit more about that and what you mean exactly?
I mean, it's massive. So there's currently $10 trillion in assets in the family office world. Compare that to roughly 6.5 trillion globally in the entire hedge fund universe. But even more important, you've got $84.4 trillion coming downstream from the baby boomers to the next gen in the next 20 years. So we're about to experience the largest transfer of wealth in history. And as a result of that, the family office market will be larger than the private equity and venture capital markets combined. So this is a massive market. Every bank, every law firm, every accounting firm is trying to get into the family office market because that's where the money is. But a lot of the family offices, they have one hand on their ear and one hand on their wallet because people know they're just trying to go to them. And the people who succeed are people who are going to succeed by leading with relationship and trust rather than look what a great model I've created.
Wow. No, that's awesome. Um, so talk a little bit more about how you're helping and impacting, the families that you're working with. I think you mentioned that you're very much more on the investment side of things. So how does that landscape look like currently, and also how do you see that changing over the years to come, given that massive transfer of wealth?
Well, the numbers will just get bigger, but I think as the money moves downstream from G1 to G2 or G2 to G3, um, I think the younger generation looks at things a little bit differently than my generation or even older generations. And I think, impact investing is something that really started from the bottom up rather than the up down. And I think right now, roughly a third of the family offices are investing in impact investing. It's probably going to go up to about 50% in the next 3 to 5 years. But when I was growing up, if I bought a pair of jeans, I didn't look at the back of the jeans to see where they were made or who made them or how did they treat their employees. It wasn't that I was a bad guy. I didn't have the internet. We had something called the Encyclopedia Britannica. My daughters now, I've got two beautiful daughters, Zoe and Bella, 23 and 20. And if they buy a purse, they want to know who makes it, how do they make it, how do they treat their employees, where is it made? They want to know, and they have access to this information. So I think that the next generation, care, it's a generalization, but they care. This is the planet they're going to inherit. They care more, and I think they're more thoughtful in general, and I think it's a little bit more philanthropic. So I'm very bullish on that because I think that the money that's going to be left to the next gen is going to be in very, very good hands.
No, that's really good. And so given the fact that there is that change in the way the investments are being approached, I guess I'm curious to understand what do that typical allocations look like on the investment side? And as those traits of caring and doing research and access to information, where do you kind of see those allocations headed, in the future? I think you mentioned, impact investing, but in what exact vehicles do you see those, that happening in?
Well, I think right now, roughly 23% of family office capital is in private equity, about the same amount in real estate. So those are the two biggest asset classes. And we invest in everything in the private market. So that's private equity, venture capital, real estate, and credit. But I say private equity and real estate are the two biggest asset classes. But I think you're going to also see what happened was um, post. First of all, let me take a step back.
Yeah.
This is a relatively new industry, right? So 68% of family offices that exist today started since 2000, and half of those started since the crash of '08. So this is a very new industry. And you combine that with the fact that 25% of family offices make it to the second generation, 10 make it to the third, and 5 make it to the fourth, the model doesn't work. So it's a very fragmented, very inefficient, and very siloed industry today that's starting to change. I do believe we're maybe in the second and third inning in the evolution of family offices. The biggest advantage that family offices have is something called patient capital. So if you look at it, these private equity firms, a lot of times a private equity firm will buy a widget company from a family that's owned it for 20, 50, 100 years, and they'll hold it for 3, 4, 5 years, and then they'll sell it. But what's interesting is they'll sell it to another private equity firm, right, who's looking at the same data, and they'll hold it for 3, 4, 5 years, and they'll sell it perhaps to another private equity firm. So if you look over the course of 20 years, you could see the same firm being sold 3, 4, 5 times. And if you look at the transaction costs, the friction, the taxes, and the disruption of the business versus a family office who could simply buy it, hold it for 20 years, let everything compound, the results are exponentially better with the family office. Now, having said that, we're not there yet because only maybe 10, I'd say 5 to 10% of family offices are structured where they can compete with the Carlyles and the Blackstones. 95% of the family offices that are in existence today don't have the infrastructure to do it. I think that's going to change, but we're not there yet.
Wow. No, and that was going to be kind of my next question, whereas you talk about this growing, percentage of family offices and their economy that they have collectively, it almost makes me think about the impact that it can make on a macro level in terms of the way people start looking at investment opportunities. And I guess to follow up on that, do you see down the line, more longer term perspectives on investments, given the fact that if the family office is going to be growing exponentially and they're going to be getting more involved in structuring themselves as kind of these institutional type firms, is that going to kind of change the landscape on investment horizons, being longer rather than your kind of, 3 to 5 year hold on the private equity side?
Yes, it is a superior model. But remember, right now, most of the family offices don't have the infrastructure, or the bandwidth, or the bench strength to do it. I mean, we've done some stuff with a perfect example is like the Pritzker family office, Tony Pritzker and JB Pritzker. It's run by a friend, Paul Carbone. They've institutionalized this. They've got 50 people on staff, and they can compete directly with Carlyle and Blackstone, and in many instances they've got a competitive advantage because they've got patient capital. Most firms don't have that. So I think what I'm trying to do is we created a family office initiative at Stanford, and I'm going to be doing this at another one of the top universities in the world, which will be announced shortly. We're trying to bring the family offices together because, again, just because you could make $1 billion selling Beanie Babies doesn't mean you're good at buying hotels. And we saw that play out. And so you've got huge amounts of capital in very inefficient hands. And I think what happened is post-crash, pre-COVID, I don't care what you invested in. I mean, you're in the real estate space, with zero interest rates. I'm not saying it's easy, but it was a lot easier to make money. Well, so what happened was post-crash, pre-COVID, all these families wanted to do direct deals. And the thought process was, well, why should I pay a guy, smart guy like you, 220, if I could make money and not pay anything? And they were right until they were wrong. And then as interest rates started going up, not only are they not making money, they're losing money. And I think you're going to see a once in a generation opportunity now, particularly in real estate, because a lot of these assets are going to, banks don't want to own them, and they're not going to be able to refinance these deals, and they're in way over their skis. So I think that family offices learn the hard way, and I think how it's going to play out is that family offices going forward will focus on the area they made their money. So if they made their money in real estate, they'll continue to invest in real estate. They'll outsource everything else. If they made their money in tech, they'll focus on tech. They'll outsource everything else. Previously, they tried to do everything in house, and they didn't realize it didn't work until rates were no longer zero and things changed. So I think we're at a very pivotal point, and a lot of family offices are reevaluating what they invest in and how they invest.
No, that's good. And so you mentioned this family office that has 50, a staff of 50 people. And I think I'm asking this on behalf of the family offices that are listening that, that maybe necessarily aren't at the infrastructure to be able to, position themselves as a firm to compete in the marketplace. So, hearing that is a little intimidating. So I guess how does a family office that, has made their wealth in certain, many different ways, hear that and now kind of go down the path of figuring out, do they need staff in-house? How much does that cost? How much does the family need to be worth? Like, those are some of the initial questions that come into my mind. So how would you respond to that?
Well, in order for it to make economic sense to have a single family office, the number you need is about 250 million. And I come to that number, you could reverse engineer it. And if you figure out, because multifamily offices were created for families with anywhere between $5 million to $200 million in net worth. To have a single family office, you've got to pay your own accountant, your own admin, your own lawyer, your own staff, and that's expensive. And the multifamily office was created really to split that cost between 10 or 20 different families. So the multifamily office is growing exponentially. I think you're going to see a retrenchment in some of the single family offices. They'll focus on where they made their money and what they know. But a lot of the stuff they're going to outsource, and some of them are going to go into multifamily offices, in my opinion, because they should just focus on what they know. That's it. And everything else, they should find people that are smarter than them. All I've done is I've been fairly effective about surrounding myself with the people that I trust implicitly, that are best in class in various areas and who are smarter than me in different asset classes, and I partner with them. It's not complicated. And I think the biggest problem with a lot of the family offices, the biggest competitor many of them have is the ego of the founder, because they've made a lot of money selling widgets doesn't mean you could take $1 billion and grow it to 2 and not spoil the kids and do some estate planning and wealth transfer, grow the asset base. So you've got huge amounts of money in inefficient hands, and the founder of the family office just has to come to grips with the fact that anybody who makes any amount of money with anything, they can do whatever they want. I make no judgment. I'm just telling them that in order for it to make economic sense, you need a minimum of 250 million. They should stay in their lane in what they're really good at, and everything else they should find people that are smarter than them.
Okay. So then when I hear that, that's good. And I appreciate that color on that, because, 250 million in, for economic sense, that makes a lot of sense. So I guess when I think about, my question is more around the dynamic. So now you have the money, now you have the opportunity to go build a team. Now, we're talking about a family here. We're not talking about an institutional firm or a brand, or necessarily really a company, but that is kind of the route that it is structured. So how does the dynamic typically look like when hiring these individuals? Are they looking for Ivy League schools, and are they do they want these people to be able to come and also join them for family holidays? Like, what does that look like exactly?
It's a great question because you're not really working for a Blackstone. You're working for a family which has people. Um, I think one of the problems is right now that most family offices, when they hire somebody, let's say there's a graduate from Stanford or Northwestern or one of the better schools, and they're paying them $500,000 out of school. Most family offices look at that as a cost. In other words, I'm going to hire you. You're a bright kid. I'm going to pay you that cost me 500,000. When Blackstone or Carlyle or KKR hires somebody and pays them $500,000, they don't look at that as a cost. They look at that as this is a potential $20 million profit center. So it's nuanced, and until the families come to the realization that that's how they have to look at it. And one of the things that Tony Pritzker had said to me when I did a podcast with him is he brought on board Paul Carbone. So Paul's a brilliant guy, but he had a great career at Beard. So how is he going to bring him on board? So what he realized is in order to attract top talent, you have to compensate them, which means have them have in part of the deal, give them part of the carry, maybe give them loans or lines of credit. And the interests are totally aligned. So I think that when family offices start learning more about that alignment of interest, and if I have a bad heart, I'm going to go to the top heart person in the country. I'm not going to say what's the best best value. And I think that family offices are starting to realize in order to compete with these are bright firms, Blackstone, Carlyle, KKR, they're really bright. They're good people. They hire top people. But the family offices can hire better people, in my opinion, because it is a better model, but only if they figure out they get the compensation model right. And if they get the compensation model right, then in my opinion, many of these family offices will be right now, you graduate from Wharton and you're in finance, you're going to probably get into private equity or real estate or venture capital or hedge funds. Nobody's going to go into family offices. They don't even know what a family office is. One of the things we're trying to create at this top university is basically, I believe in 3 to 5 years, the top kids out of these schools, their first choice would be to go into family offices, not into the hedge funds or the real estate space.
And so how would that look exactly? Because, okay, so you have somebody graduating from a great school, they're obviously coming out with a ton of knowledge, but I initially think about, well, if I'm bringing you into my family operation, I want you to go out and get some real life experience by actually doing this, then coming on board and, maybe not essentially learning, but then now you're doing the real thing, under my family's entity, I guess you can say. So has that conversation come up at all while you're kind of structuring that type of transition right out of college into the family office directly?
Sure. Well, you're not going to just hire kids out of college. I mean, you need to hire somebody very experienced, very senior, and a couple of people who are senior, and then you sprinkle in some of the younger people who could learn on the job. But I think at the end of the day, that you know, it's not a panacea. I mean, there's nothing's perfect, right? So there are huge advantages to working for family offices. There's also disadvantages to working for family offices too. And when you're working with a family, if you're working with G2 or G3, you've got egos involved, and maybe there's 3 brothers, and maybe 2 of the brothers are really hardworking and really smart, and one of the brothers is kind of a trust fund baby. And how do you navigate that? So it's much more psychological dealing with this. But as long as you can get the interests aligned, I think it's a superior way. I think it's gonna be the best career path going forward. We're just not there yet.
Yeah, and it sounds like I think of loyalty as well. I think loyalty plays a big part in, kind of once you get in, that's probably an important aspect of, being successful alongside the family.
Well, when a family office is gonna hire you, the first, second, third thing they wanna know is, can I trust you? And the fourth thing is, what's your track record? What's your 1, 3, 5-year drawdown, et cetera? That's flipped institutionally. So when you work for a pension, pension fund is going to look at a real estate firm or look to do a deal, they want to know what's your 1, 3, 5 year track record, what's your biggest drawdown, what are the statistics, and then they'll diligence you as a person. It's flipped. This is a complete relationship business. And remember, a lot of the family offices came into existence. It's not that they all wanted to manage their own money. It's that they stopped trusting Wall Street, justifiably. And so the growth in this was that, not everybody all of a sudden, I want to manage money, because some people love it, some people don't, some people are really good at it, some people aren't. But the growth has happened primarily because there's been a mistrust in Wall Street, and people figure if they could get people in place with interests aligned, you could do better. And I think they're probably right.
And what are the type of return expectations from the family office? I'm curious to know if that fluctuates from, what generation, is it generation one or is it generation four? What are they looking to just preserve capital, or are they also are some families really focused on growing, growing the wealth?
It's a good question. It's all over the place. So you've got some families that are looking just for wealth preservation. I'm worth X. I don't need to work anymore. I don't need to grow the assets too much. I just want to preserve the money. And that's one strategy. And then on the other end, you've got families that want to they're worth $100. They want to be worth $500 and they want to grow it. So it depends. As long as you clearly identify what the strategy is and you let the people who are working with you know what the strategy is, that's really the most important thing. But it's all over the place. It's people who want to just do very conservative wealth preservation to very aggressive, I want to triple the asset base.
No, that's good. And then my one question before we kind of go to our fire round here is, do you typically see, the family that is worth 250 million dabble in the multifamily office space first to kind of get their feet wet and learn a little bit alongside other families before they go and create their own? Or, how do you ever see that kind of step? Like, what do the steps look like essentially?
Some do, many don't. Many have a liquidity event, so they could do it. They figured they could do it themselves. And I think they're going to be a retrenchment because they started to do the direct deals, and they realize, it's hard. You can't be really good at real estate and private equity and venture capital and credit and cryptocurrency if you invest in it. You can't be good at everything. You can be good at something, one thing, or maybe two things. And I think so. Some of the family offices started with a multifamily office, then morphed, but more of them started as a single family office, in my opinion, will morph into the multifamily offices.
Okay. No, that's good. So we'll kick it over to our family office fire 5 rounds. So I'm just gonna ask you 5 questions that I ask every guest. And we could run through them fairly quickly, but definitely, don't cut yourself short either. So the first question here is, what is a common misconception about your field of expertise that you'd like to debunk?
That because somebody is wealthy, they're necessarily sophisticated.
No, that's good. Um, the second question is, what is the most memorable or unusual experience that you've had in your professional journey?
There's been a lot. I'm gonna pivot. I'm gonna come back to that one.
Yeah, yeah, no worries. And so the third one here is, what's one piece of advice that you would give to someone just starting out their career within the family office space?
Be authentic. What Shakespeare said, be true to thyself. Just be honest. Know who you are. Know what your strengths are. Don't bullshit, and just be honest. And I think that will get you a lot further. I used to only want to work with the smartest people in the world. Um, integrity, intelligence is a commodity. Integrity is not. And I think that's something people have to understand.
Yeah, no, that's good. And I for what I've noticed, and maybe this isn't across the board for every family, but I think it's probably encouraged, is coming up with your own kind of core values and your principles. So my question to you is, what are some of your personal core values for you and your family?
So I can elaborate on this one a little more because there's a story behind this. So my daughter was maybe 6, 7, 8 years old, and we have a thing in our house where if you call 3 times, it's an emergency. So I was meeting with a large family office, and I got a call 3 times. So I just excused myself and I talked to my daughter and I said, "What's wrong?" I was concerned. I didn't know if she was in the hospital or what had happened.
Hmm.
And the question she asked me is, "What are the 5 most important things in life?" I'm like, what's the emergency? She was like, I need to write this for a paper. So I took a deep breath and I'm like, okay, this isn't an emergency. And then I'm like, we'll talk about it when I get home. And we went home. I went home that night and I said, well, first of all, that's not an emergency, right? That's
Let's address that up front.
that is clear. But secondly, so I tried to help her with it. So she was 7 years or 8 years, I don't know, 7 or 8 years old.
Wow.
And so I worked with her. So for her, it was like being popular, being a good listener, being a good daughter, being a good friend, maybe one or two other things. And then as only a kid could do, and if people who have kids know this, they're like, all right, what are yours? And I don't have to answer to you. But I did think about it. And then she asked me another week ago, what are your five? And I thought about it. And I talked about it with my wife, and I did start thinking about this. Like, okay, if I have to do this assignment, she had to do it, I'm going to do it. And mine are in order: love, gratitude, attitude, balance, and laughter. Those are my five, and everything in order, and everything comes from that. And so other people, religion's much more important, or other people, other things are more important. Those are my five. And I think if you get those five right, I think everything else follows. So those are my five values.
No, that's solid. Because I think your point is like being in the industry, sometimes, you have other people thinking about it on their end, and then you kind of take a step back to like, I should probably kind of figure this out myself as well. So it's good to hear that. I think we kind of touched on this question a little bit. So the last question here is, where do you see the family office space headed over the next 5 years? So I think we kind of did touch on that a little bit, but I guess, to kind of narrow it down a little bit is, what is one key component that you're really focused on, within the family office space over the next 5 years?
Well, two things. One, I think that as private equity and venture capital disrupted the public markets in the mid 80s because it was a better model, I think that family offices are going to start to disrupt private equity and venture capital because it is a superior model. But the one area that my North Star is kind of the inflection of prosperity and purpose. So I don't think that all these family offices are going to solve all the world's problems, but I do think many of them can solve a lot of them. So my dad passed from prostate cancer when he was 57. The exact same time he developed prostate cancer, Michael Milken, who was a visionary at Drexel Burnham, developed prostate cancer. And what my dad did is he went to the best doctors and got second and third opinions, which is what I would have done and what most people would do. What Milken did, he wanted to solve this, right? To save his life, but he wanted to solve this. So rather than throw $100 million at the American Cancer Society, he built it like a venture capital fund. He put 2 million here, a million here, 3 million here, 500,000 here. And because of Milken, most men will die with, but not of, prostate cancer if we live long enough. And then you fast forward 30 years to the once in a generation pandemic. I would argue Gates did more than the US government. So I don't think you can run a philanthropy exactly like a business, but I think you can run it more business-like. And I do think my North Star is taking some of these entrepreneurs who have the means to do it, and whatever their cause is fine, and having them solve some of these problems, because it's not going to come from the government, and it's certainly not going to come from the corporate sector.
Yeah, no, that's actually a good point. I never thought of it like that. So I am going to go back to this question. What was the most memorable and unusual experience you've had in your professional career? And just to throw that out, just to throw this out there, on top of that, to maybe get some thoughts going. I would be curious, or unless you have it,
No, I do. It was unquestionably when I first started, when Drexel went bankrupt. I mean, I'm in a room. This was the most profitable firm on Wall Street by far. They created the junk bond market, which was growing exponentially. I'm watching men in the late 80s weeping, which typically didn't happen. That is something that really, and again, that really stuck with me. And based on that is why I don't think I would have started my own firm. I think I would have had a different trajectory. I think I would have probably done fairly well otherwise, but a part of it was this bad thing happened. And because of that, what's my takeaway from it? So that's the most memorable thing, being in the room when Fred, Joseph, and Don were going bankrupt, and I'm watching how people react to losing most, if not all, of their money.
Wow. No, that's good. And so, to top it off here, where do you see yourself going, from here? What are some of your goals now that we're here towards the end of the year, going into 2024 and just, moving forward as you continue to excel within the family office space?
What I want to do is more look at from a macro standpoint, and the reason I'm uh, doing this with a university is because by I think that we as a family office community, which is again inefficient, fragmented, and silent. There's roughly 15,000 family offices throughout the world, but they're very siloed. And just because you made money in real estate in Chicago doesn't mean you're connected to everyone everywhere, right? So what I'm trying to do, my big picture, is to tie it with the university to get these family offices to work together more collaboratively. Because if we do that, we could change the way companies are financed, and we could change the way some of these real world problems get solved. And that to me is my North Star.
No, that's awesome. Well, Ron, this was great. I mean, I know I definitely got a lot of value, and I'm sure the listeners will as well. So I just want to thank you, for the opportunity and your time. If people wanted to reach out to you, what's the best way to get in touch and just get connected with you?
Sure. Well, probably through LinkedIn. I write a lot of content on LinkedIn, and then I've got a podcast. It's called FamilyOfficeWorldPodcast.com. I just did a podcast with David Rubenstein. I did one recently with Tony Pritzker. So that's another thing, way people could kind of learn a little bit more about family offices, but probably through LinkedIn is the best way.
Awesome. Well, Ron, again, thank you so much for your time. Appreciate it.
My pleasure. Thank you for having me.